The Federal Reserve is widely expected to cut interest rates at its next meeting on September 17th and 18th, following a series of rate increases that started 18 months ago in response to the spike in inflation. The Fed's preferred measure of inflation, which is the annual personal consumption expenditures, or PCE price index, now sits at 2.5%, down significantly from its most recent peak of over 7% in mid-2022. At the same time, the unemployment rate has risen and monthly job growth has slowed since the Fed stopped raising rates. And so now here we sit on the cusp of what will at least be 1/4 of a percentage point reduction in the Fed's policy rate, with the door seemingly open to further and larger cuts as needed to support job growth. So what kind of effects could these rate cuts have on us as consumers and as investors? Hey, if we haven't met, I'm Corneille with Choice Wealth Management. We're an independent registered investment advisory firm located in the Atlanta metro and serving clients nationwide. Our mission as a firm and with this channel is to assist you in making the right financial choices to grow, preserve, and protect your wealth. So if you feel so inclined, please consider liking and subscribing. All right, so what moves should we be thinking about in light of these upcoming rate cuts? Well, the first thing to understand and recognize is that the Fed has the power to raise or lower what's called the federal funds rate. That is the rate at which banks can lend money to each other. However, things like mortgage rates, loan rates, bond rates, CD rates, they're not going to move in lockstep with the federal funds interest rate decisions. Rather, these types of things are impacted by expected future Fed policy decisions. Economic markets have been anticipating this first rate cut all year, and so that's reflected in the declines that we've already seen this year in mortgage rates and treasury yields, for example. So if you've been waiting till October to, say, refinance your mortgage or take out a loan, there's probably little to no benefit to doing so. Because again, current interest rates on long-term loans are typically going to reflect information about future anticipated cuts. However, we also know that the consensus among economists is that the Fed will do 4 rate cuts next year, in addition to a possible second one later this year. So with all that in mind, if you were considering a refinance or taking out a significant loan, it could be beneficial to delay doing so until the latter part of next year, if at all possible. Now, from an investing standpoint, there's a couple of things to keep in mind as it relates to stocks and bonds. First, as far as bonds are concerned, there's an inverse relationship between interest rates and bond prices. When interest rates go down, bond prices go up. Remember, bonds are debt instruments like treasury bonds. These are debt instruments of the US government. Corporate bonds are debt instruments of corporations. So a quick example, let's say you own a bond from XYZ company and it's paying 6%. As interest rates go down, new bonds issued by XYZ company are now only paying 5%. So because you have a bond paying a higher rate than what is readily available on the market from that issuer, your bond paying 6% becomes more valuable. When interest rates go down, bond prices go up. And of course, the opposite is true. As interest rates go up, bond prices go down. So bonds should do well in this environment, especially if we see the future rate cuts as anticipated. But again, remember that this September rate cut has been widely anticipated and is pretty much priced in at this point. Okay, what about stocks? So the stock market typically sees double-digit returns when the Fed is cutting rates, depending on why the Fed is cutting rates. So when the Fed lowers interest rates, they usually do so for one of two reasons, either because they can or because they have to. Last time the Fed cut rates in March of 2020, it was during the height of the pandemic. The economy had come to a screeching halt. And so the Fed had no choice. They had to lower rates to support the economy and help a recovery. Same thing happened in 2008 during the Great Recession. Now the Fed is cutting rates because higher rates have done what they were supposed to do, which is bring down inflation. These rate cuts are also coming at a time of accelerating earnings growth and still relatively low unemployment. So yes, when you factor rate cuts and the context in which these rate cuts are coming, you have an environment that has historically been very good for stocks. But with all that said, still keep in mind that your investment strategy is just one part of your overall financial plan. And as always, be sure to consult with your financial, tax, and legal professionals to see what makes the most sense for you and your situation. And if you're in need of support or a second opinion with crafting the right investment approach, that can aid you in reaching your financial goals, please feel free to use the calendar link in the description to schedule an introductory conversation. And lastly, always remember that while growing, preserving, and protecting wealth is important, to quote the great Luther Vandross, the best things in life are free. Hope this was helpful. See you on the next.